Well, hello, students. This is Professor Watts, and today we are going to do some capital value exercises in Excel to illustrate the valuation concepts and the time value of money kind of math and the role of interest rate changes in capital values that we've been looking at in intermediate micro. And what we want to do here is just understand kind of a basic valuation framework. We're not going to get too fancy or too complicated. We want to think kind of big picture. What's the role of the interest rate and other key variables? The magnitude of income streams, the durability, the length that the income stream lasts. And we can use this to think about valuing any kind of capital, whether a investment security like a bond, a productive asset like a piece of land, or perhaps the most productive asset of all, which is human capital, which is your knowledge, your training, your skills, and abilities, productivity. Um, that's capital in a very more deep and rich sense than any physical asset. And we can't value it exactly the same because the way markets work, um, the market for human capital is a job market. So there's some complexity and nuance, but the concept of capital values is still very, very useful, and I hope to illustrate that across the board here. We also look at the concept of rents being capitalized into present values. Okay, so the first exercise, bond pricing, we'll keep it really simple. The nice thing about bonds is all the terms for a present value calculation are given, they're set, they're locked in. The only thing we might need to kind of think about and do some analysis with is the interest rate at which we value the bond, but not the interest rate that the bond pays, the coupon rate of the bond that's given. But in these little exercises here, I'll give you everything you need. And so we're just kind of plugging and chugging the present value formula in Excel. And you'll notice here, if you've been in a different class with me, notice the familiarity. I organize the components of the function in the way Excel asks you for them. So up to 5 components in a present value function. The rate, this is the rate that the discount rate or the interest rate that we're valuing at, the number of periods, the payment per period. So this would be the annual cash flow, the periodic cash flow, the future value. And a bond, of course, will have a future value of like $1,000 or $10,000, something like that. That's the principal payment you get back at the end of the bond. Other assets can or cannot have future value. Sometimes we'll see it doesn't really matter when we're valuing like a really durable assets that have really long lives. A lot of times we can just kind of ignore that. We can set that to 0. And then the type, beginning or end, I always just go with end. It doesn't matter that much. It's when the payments occur. End of period, 0. Okay, so let's just read the scenario and plug and check here. Find the current value of a 5-year, 5% coupon bond. Okay, there's my N per 5. 5% coupon, 5% of the $1,000 face value of $1,000. That's $50 per year. And the future value is 1,000 because it's a bond, $1,000 bond. Now it says the current interest rate on similar assets is 3%. That's what we want to discount by. So 3% goes in there. Type, as I said, always goes to 0. Now let's just run the present value function equals PV. Rate, you can see the logic of structuring it this way. Click the cell. In per, click the cell. Just down we go. Payment, click the cell. Future value, click the cell. Type, click the cell. Now, this is going to give me the PV as a negative number. And the reason why is because it's just a quirk in Excel. Excel wants to treat positive numbers as outflows and negative numbers as inflows, or sorry, vice versa. But with time value math, we want to set the payment up as a negative, and we also want to set the future value up as a negative. So make sure you set the make sure you set the payment and future value up as negatives, and that'll make the present value positive. That's my preferred way to do it. Okay, so this bond is worth $1,091. And why is it worth more than the 1,000? Well, because the interest rate that we're valuing it at is lower. This thing pays a higher interest yield on its face value, 5%, $50 a year. And if you went to buy a similar bond from a similar that's what I mean, similar asset, similar credit risk issuer, that'd only be paying you $30 a year. Well, this bond has become more valuable because it's paying $50 a year. And in fact, at a price of $1,091.59, the $50 that this bond pays is a yield of 3%. That's exactly what's happening here. Now, Excel makes life easy for us if everything stays the same, which you'll notice I do have the same thing. 5-year, 5% coupon bond. The interest rate's going to go up to 4%, down to 2%. So all we need to do is copy everything, paste it. Copy everything, paste it, and then just dial that interest rate up to 4%. That makes the value of the bond do what? Go down. Dial that interest rate over here down to 2%. That makes the value of the bond go up even higher. Interest rates are inversely related to asset values. Let's take care of that right now. Now, I want to calculate the change in value. So I want to, the value of the bond went down. Let's subtract the smaller number from the larger number. Actually, no, let's do it this way so it shows as a negative. Take the end value minus the beginning value. That's what we want to do. So it went down by $47 here. And this one, let's take the end value, subtract the beginning value. It went up by $49 here. You'll notice a relatively proportionate increase or decrease in price with a given point value change in the interest rate. Bond values and interest rates are inversely related, or asset values and interest rates are inversely related. Okay, so there's the basics. Now, let's move on to a somewhat more real, or I shouldn't say more realistic, but real world application, commonplace application. And I did a small amount of research to make this at least somewhat ballpark realistic. There's a lot of details. I'm not a farmer. I know a little bit about it, but it's good enough for our purposes, for illustrative purposes. So I want to go and value a piece of good corn growing farm ground on the basis of the income we can get from corn farming. So I looked this up. An acre of corn growing land maybe yields about 160 acres with kind of a high input farming model. And then these are all the costs in that, some of them in that high input farming model. And I just went and looked at corn. You could probably sell your corn into the future market for about $4.50 a bushel right now, December 2025. So let's start by calculating the gross revenue, the bushels per acre times the price per bushel. So this land per acre is going to give us $720 kind of expected average income. Now, all of this represents the costs: seed, fertilizer, pesticide, equipment, labor, depreciation, etc. I don't know if this is super comprehensive, but it works fine enough. So the net then is going to be the gross minus the sum of those inputs. And okay, yes, closing parenthesis is needed there. All right, so our acre nets $172 per acre. It's a pretty good income. And then we can take that, and for some reason I put the interest rate way over here, but at that interest rate, we will value this cash flow stream, PV, equals, PV rate up here, 5%. Now I'm just going to use a 100-year convention, 100 years. Payment, remember I got to put a negative sign on this. It's the net income from the acre. That's the payment. That's the cash flow. It's not the total revenue. It's the net income. And then 0,0. Now, I'm saying the land has no value at the end of 100 years. No, but I'll show you in a second here. It doesn't really matter. So I get a present value of $3,413. Let me just show you. I don't want you to do this in the assignment, but let me change the input to 1,000. Oh, and it went up to 3440. So it went from 3414 to 34,400. So it's not a meaningful difference. So 100 is probably just fine. Now, why does it only go up by, what was that, $27 when we increase the time span so much? Because all of the cash flows that occur 100 years out into the future, some of them are worth a few dollars today. If it occurs 1,000 years in the future, it's going to be worth a few cents today because we're discounting it so much. So who knows what's going to happen in 50 years, let alone 100, let alone 1,000. So we can just choose kind of some arbitrary large number. 100 will be fine. Now, I want to do the same kind. So this land is worth $3,400. Now, you might see that it's sold for a little bit more than 3,400 because there is some optionality in the value. What else can you do with the land? Well, you could grow other crops. You could maybe hunt on it, recreation. You could maybe develop it if it's close to cities. So this would be, I would say, this is kind of the basis of the valuation. This is not necessarily the valuation because there's always other options that can kick in. Now, what we would also want to notice is that what is this valuation subject to? It's subject to changes in these input parameters, in these income parameters. So, what if the soil's not as good in our part of the country, and we can only get like 120 acres, or sorry, 120 bushels per acre? Of course, then we might kind of have to crunch these costs down as well, because right now I've got it going negative. Let's go 130. That makes that net income much lower per acre, and it makes the land value much lower as well. And notice there's a huge difference here between 130, 160. What if we get that income bushels up to 200? It becomes worth a lot more. So land, the valuation, of course, it's based on its marginal productivity. That's it's the rent that's earned by the productivity of that unique location. It's a rent, you'll remember. So we could also, of course, change that on the basis of the price. If corn becomes way more valuable, that land becomes way more valuable. And then, of course, let me go back, the interest rate. If the interest rate drops, the land becomes way more valuable. Now, I want you to just keep this at 5%. You should have about 3413 right here. I just wanted to show you, I did this as a perpetuity. Um, Actually, a true perpetuity. I use the net present value function, but let me show you what a true perpetuity would look like. That would just take the net income and divide it by the interest rate. You don't have to do this in the assignment. I just want to show you. We're going to get pretty darn similar results. 3413 versus 3440. 3440, that's the exact same result I got by using an INPER of 1000, by the way. So the perpetuity is just a income stream that goes on forever, and the math there becomes very simple. You just divide the cash flow by the interest rate. So that's just for comparison purposes. Now, I do want to do this valuation for this result at different interest rates. Let me show you how easy this is. PV, this time the rate is going to be the variable in the adjoining cell. The INPER will just do 100 again for convention. Payment, remember to put a negative sign. Oh my goodness, let me start over here. Negative F16, but we want to lock that in because we're going to fill that formula down. And then future value 0, type 0, press enter, fill it down, and we have a matching result for our 5%, yep, 3413. And you can see there's a pretty significant change in the valuation. If we move the interest rate a little bit down, the value's jumping by $2,000. If we move it 200 basis points down in the interest rate, if we move 100 basis points up, the value goes down by $600. But we run this for 7 and see what we get. And we go up 200 basis points, we lose about $1,000 of value. So you can see the very consistent relationship there between interest rates and asset values, all through the math and the logic of discounting cash flows. Here's another fun one. I have this in my monetary class, but I modified it some. We'll play with kind of a different aspect of valuation here. So I have this, a rental property is expected to earn $16,000 in net income. So after you pay all the overhead and maintenance and management costs, you get $16,000 coming in rents. You expect the unit to last another 20 years before needing total replacement, i.e. its value will depreciate to 0. It probably doesn't actually depreciate to 0, but just to make life simple, we'll say the future value is 0 and the INPER is 20. And it says your opportunity cost of capital is 10%. Which consists of the 7% return you could get on a broad market equity portfolio. That's kind of your opportunity cost of investing in passive, easy assets, long-term expected rate of return, plus a 300 basis point risk premium. So the idea is if I'm going to go invest in a more high risk, high touch, high maintenance type of asset, I better be getting a substantially higher return than I could get with just hands-off, passive, easy investment. So 10% goes into the rate. And then let's see, the payment is the 16,000. Remember, as a negative, Excel likes the payment to be that way. Now, the present value is just run that present value function again. Just click on down the line here. Excel makes life really, really easy for us. So that thing should be worth, that cash flow should be worth about $136,000 right now at a interest rate, a income yield of 10%, given that it lasts for 20 years. Okay, now we could play with a lot of things there, like what the interest rate, the INPER, making improvements to boost the income. And I encourage you to, once you learn how to do this in spreadsheet, it's pretty easy. It's so easy to just copy and paste over here. Uh, Paste that over here and then change some parameters, say, well, we can maybe make it last for 40 years and its value goes up. We can maybe get the income up to 24,000 by making some improvements, and then its value goes up, and so on. It should be negative 24,000. Its value goes up $100,000 if we can get the income up by $8,000 a year. Well, if it's worth spending maybe $50,000 to achieve that outcome, so on and so forth, right? So you can do a lot of kind of scenarios and what ifs and help you calculate and find opportunities. So that's all well and good, and I encourage you to learn that and practice with that and develop those skills, because they're going to be useful to you in a corporate setting, and if you're in a financial firm or investing or just dealing with um, management, or personally, because you might be going off as an individual investor or entrepreneur, and you need these tools as well. Okay, now I wanted to do a few more things, a little bit more advanced here. Do some analysis of kind of the cash flow and the returns that we're getting from this investment. So first off, because I want to think about kind of what's the return on assets and equity and cash, I want to say, how much did we have to spend up front to acquire this? And typically when you finance a property, you're putting in something like, if it's an investment, typically something like 20% down payment is pretty common. They call that an 80% loan to value ratio. If it's your personal residence, often you can get away with a 10 or 5 or 3% down payment. Lot more risk for the lender there, but 80% of value. So that means the mortgage is equal to 20% of the value. And we'll just say we make an offer of 136,217 and it's accepted. So we have to come up with 27,243 as the down payment. Wait, I want this to be the mortgage. So actually I'm going to multiply 80% times. Oh yeah, I remember why. I'm calculating the mortgage here, the down payment. Maybe I'll write the down payment in over here. I'll just write this over here. 0.2 times, equals 0.2 times. Okay, so let's do that. This is the down payment. And then this is the mortgage. Now, the reason I wanted to calculate the mortgage amount is so I know what the mortgage payment is. And I gave you some assumptions over here. The payment is at a rate of 7%. We can finance this at 7%. I think that's about right for these days. INPER, it's 30 year. We're going to do the payment notice on a yearly basis. If we wanted to do it on a monthly basis, we could. We'd have to divide the rate by 12 and then multiply the INPER by 12. But this is good enough because we just want to know the yearly cash flow here. So let's calculate the annual mortgage payment. Present value is the amount we're amortizing in the mortgage, C16, and it gets amortized down to zero. It gets paid off. So the future value is zero, and we'll just always go with zero for type. So the payment, and I'll keep this as a negative number because this for us is an outflow, and that's just fine. $8,780 per year is how much it costs us to acquire a cash flow of $16,000 a year. So here's what I want to do now. I want to say equals 16,000, and because this is a negative, I'll add it. So I get a yearly cash flow of 7,218. And so that looks like a pretty decent investment if all this stuff is legit, if all these numbers are correct, if our estimates are good, which is an entirely separate question. Now, we can calculate a few things here to compare this investment against others. First off, cash on cash. How much are we earning? We're earning, well, I should say not how much are we earning, how much cash are we generating after everything's said and done? $7,200. What did it take for us to achieve that? It only took a down payment of 27,000. That's a cash on cash return of 26.5. So for the 27,000 we had to spend outlay to get this property financed and acquired, we're going to earn 72.18 after everything's said and done, 26.5. Pretty decent cash on cash return. I've seen higher, but that's not terrible. Return on assets. Now the return on assets is the total income, 16,000, divided by what it's worth. What is it worth? It's worth 136, 11.7%. And again, it's like in comparison to what? Sounds a little bit better than just kind of what you could earn on passive bond portfolio, probably 5%, stock portfolio 7+%, and it has to be right because there's a lot more risk in this, and a lot more bad things could happen to one particular property in one particular neighborhood than will happen to the entire global stock market. Okay, return on equity. Return on equity is again the income. And now it's divided by not the total value of the asset, by the amount that is equity financed or owned outright. That's the equity, the down payment. So of course, and that's 59%, and that's going to always be higher than the return on assets if debt financing was involved, which of course here it is. We want to boost that cash on cash return. We probably want to make that down payment, that equity stake, at least initially, as small as possible. And then finally, internal rate of return. Now, what is internal rate of return, IRR? That is just the interest rate that makes this thing a wash, that makes the present value equal to zero. Now, the way to do this in Excel, and you might have noticed here, I have these grayed out numbers in here. It's like a cooking show. Here's one I prepared earlier. Let's make them blue. So what I did is I just mapped the cash flows from year 1 or 0.0 to year 30. So on day 0, we spend 27,243. That's just the negative of the down payment right here. And then we get I don't know why I say 3,200. This actually, let's make this equal. 72, 18, 12. There we go. Oh, I know what I want to do. I want to copy and paste that. And then I want to fill that all the way down. I was playing with different numbers earlier. Okay, we're going to get a cash flow here of 72.18. That's right. For 30 years. So our internal rate of return, IRR, the way this works is you just select that entire range, and they have to be contiguous. They have to be stacked on top of each other, comma. And then the guess is just, this is an iterative process, so it wants an interest rate to start with. Well, the IRR here is probably going to be pretty close to the return on assets. So let's just say 10%, 0.1. And is that right? It's given us an internal rate of return of 26.5. So yeah, I was just double checking my math there because it initially looked oddly similar to the cash on cash. It's just a coincidence, but they're technically different numbers, added some decimal places. So an IRR of 26.47%, what does that mean? That means to make the present value of this series of payments, so an outlay and then followed by incomes, to make that zero, to make that kind of a wash over time, we would have to discount it at 26.4%, that's a high interest rate, right? Which means what? If we discounted at anything less than 26%, this thing's going to have a positive present value, meaning it's going to have a positive capital value. It's going to be wealth enhancing. So this is a good deal. I mean, that's a good rate of return to be earning, and that makes this is a pretty attractive deal. I've seen IRR projections also higher than 30%, but there's a lot of risk in those kind of deals. So if we are confident in these numbers, like if we've done our research and diligence and we like the property and we like the neighborhood and we think that there's growth there and we're going to have no problem getting the rents and everything else, probably should jump on this. It's probably an excellent opportunity as long as we know how to run the management and everything else. Of course, profits accrue to knowledge. You don't want to forget that. Part of the knowledge, though, is being able to analyze the basic time value mathematics here of the valuation, right? The investment proposition. Okay, moving along. I've got one for kind of for you guys for thinking about human capital investment. And this is, I don't know if this is totally realistic. I did look up some data on this to try to get some somewhat roughly realistic numbers. I think you could go get a decent job now for $50,000 if you have a kind of decent skill set, work ethic. Um, that works out to about $25 an hour. So I want to say, what's the opportunity cost of college? It's you could start working now, and if you start working now and you're diligent, your income will grow over time. We're going to kind of assume an inflation rate in your income. So I'm going to just do this equals the base salary. I'm going to make an income series here, and then for the remainder of the series, I'm going to take the previous number and multiply it by a growth rate, which is 1 plus the inflation rate, and I'm going to just fill. Oh, I have to lock my reference. Like, what did I do wrong there? I got to lock that inflation reference. There we go. Yeah, make sure you put the dollar sign in that so it always uses C3. You can go all the way down to the bottom here and see that it's the previous value times 1 plus the growth rate, which is always there parked in C3. Okay, now, what is the net present value? NPV. This is kind of like the IRR calculation, although you do need a rate here. I'm going to use 7%. That's my long-term rate of return kind of baseline. And then the series of incomes. Now, there's no outlay if you go get a job right now. So that gives us a net present value of 977,000, pretty close to $1 million. Okay, so your lifetime income, how many years did I do this for? For the next 40 years is $1 million. If you just go get a job now and kind of climb steadily, and that's decent, that's respectable, no shame in that at all. But let's see what could happen. I did look this up. You kind of starting salaries for bachelor degrees in econ, and there's a pretty wide range here. But I'm confident that the average around here is something like 65,000. So you get a nice bump starting out, and then of course that'll climb pretty fast. I'm going to be very modest, very conservative in my projection, but I'm going to have that salary climb faster because you have more human capital, maybe more opportunities. So I think realistically it might climb at double the rate, but I'll be conservative and say it climbs at 4% instead of 3%. So again, our income here starts at that. The growth, I'll just copy the formula over, except it's going to be not C3, it's going to be G3. And then we'll fill that all the way down. And you can see here, we're running 6 figures here by year 12. Oh, I did one thing wrong though, didn't I? I did one thing wrong. Let me back this up. That doesn't start in year 1, does it? That starts in year 5. Yep, I'm glad I caught that. That starts in year 5. This times 1 plus this, right? Lock that cell reference. Okay. All right. So you do start off ahead though in year 5 of what you would have got with that lower paying job and a lower growth rate. So as you might guess, this is probably going to be considerably more attractive, even with that opportunity cost of missing those first 4 years of income. Net present value, again, 7%. Let's use 7% for the rate. And then I'm going to take all of these because I have to discount this back to, to today, including the 4 years in which we're not going to have an income like differential. Now you could put numbers in here if you wanted, like, well, I'll have a job in college, but let's just assume that that's kind of a wash. That's just paying your expenses during college. So to make life simple, we'll just say that's F5. Let me start over here. I want to click and drag all the way down to here. Okay. And I need to put a closing parentheses on there, apparently. What am I doing wrong here? Oh, I typed the formula name in, the function name in. Okay, there we go. And that's okay. So that's pushing us towards 1.3 million. Oh, but that's not the net present value because that's the value of the income series. But then I have to say, what is the outlay required to achieve that? That's why I have this right here, net cost of college. Okay, so that makes it a little bit lower, but still 1.3 million versus just under $1 million. So a increase of let's do this. The present value of your college enhanced earnings, let's say, versus the present value of your non-college enhanced earnings. The degree is not worth the 1.3 million because you could have earned 977,000 without it. The degree is worth what? The difference. It's the marginal increase in earning power that should constitute the capital value of the degree. And I would suggest to you this: if the capital value of the degree, the marginal bump in the present value of lifetime earnings, is higher than the net cost of college, it's a really good chance that the degree is worth it. If the capital value of the degree is something close to the cost of college, and it might not be worth it at all. Of course, if this capital value um, doesn't cover the cost of college, it's a terrible investment. Now, it still might be a useful thing to do on other fronts, but if we're just thinking of this as like a financial investment, this is the kind of math you want to look at. I said, let's do something kind of interesting in Excel. Let's run a break even to say what is the minimum enhancement of um, salary that would make the college degree equal to the non-degree, based on the fact that you have to wait for the income to accrue. So let me try to remember how I did this. I'm going up to data. This is going to be one of my favorite things in Excel. Go over to what if, go to goal seek. And what I want to do here is I want to set the capital value of the econ degree. So I'm going to select I5 there to 0 by changing the base salary. And for that to be true, our income would actually have to be lower, interestingly. Oh, because I still have the inflation rate. Let's do this. Let's put the inflation rate back to 3. And let's run that again. What if analysis goal seek, set I5 to 0 by changing the salary. Okay, so then that comes out to 55,619. So I'll write that down in here, 55,619. Now, what does that mean? That means if your degree doesn't get you a starting salary higher than 55,619 and or a growth rate higher than 3, you didn't come out ahead in terms of the present value, in terms of the capital value of the enhanced income stream. And that's pretty modest, right? You need a 10% bump. I was sharing data on college wage premium with my principals class a few days ago, and I think the average college wage premium is still pretty close to $30,000. So, what if your salary is 75,000, your capital value is up to, and let's say your growth rate is, I'll be maybe a little more generous here. Your growth rate's 5%. Wow, that capital value really starts to rise. So the better degree you can get, the better starting job you can get, the faster you can grow your income, the more worth it becomes. Right now, of course, all these things intuitively. This is a toolkit to help us to put actual numbers, actual valuations, and maybe kind of make really concrete comparisons, or kind of a more precise, more rigorous kind of evaluation, let's say. When you hand this in, I want this to be back at 65,000 and this to be back at 4%. Okay, that's what it should look like when you hand it in. Okay, final thing here. Let's go back to the farming, valuing the acre of land, valuing a fixed asset, a long-lived, durable asset that's earning rents if it's got superior productivity. This one's not going to have superior productivity. This is based on a real-world scenario that my dad has been involved with. He had some farm ground in the high plains in Colorado, very miserable, almost worthless ground. But that's where he is, and he likes it out there. He's kind of a rugged cowboy type guy, and it's good for him. Anyway, it's pretty meager land. It's dry land. It doesn't get much rain, and you can't grow much on it. In fact, I looked this up as well. You can probably expect on average to grow like a ton an acre of hay, which is like almost nothing. If you know anything about agriculture, that's just pathetic. It's sad. Like, why would anybody even try to do that when you could farm in the good soil and good moisture here east of the Mississippi? Anyway, some people tried and a lot of them failed. Some people still do. They're eking out a living out there. So this is the same thing as the farm acre for the corn problem. We're just going to multiply the yield by the price. I also looked this up, something maybe like $130 a ton for sorghum hay, which you can feasibly grow on dry land. And then I kind of looked up, I put in quasi-realistic numbers to here for the per acre costs. Okay, then we'll do the same thing with the acre net. We'll take the gross and we'll subtract the sum of the costs. So if this only earns $28 an acre, what's it going to be worth at a 5% interest rate? PV, 5%. In per, I said use 100 here, same convention. Payment is the negative of the net cash flow income, 0, comma 0. It's only worth 555 bucks an acre. Wow, it's worth a lot less than this really productive rich farm ground, isn't it? A lot less. Now, let's do the same thing where we value that at different interest rates. This time the rate is a variable, cell-based variable. The in per is always 100. The payment is always the negative of the acre net, but lock that in, please, so we can fill the formula, 0, comma 0. So I'm going to go down to 3%. This thing becomes worth, wow, $885. Up to 6%, the value gets knocked down to $465. Now, I want to do one more calculation here to kind of show you the logic of this. Yield of total cash flow on this valuation. Well, the total cash flow is always the $28. And by the way, with an acre of farmland, you want to treat this as an average. You'll have a dry year where you might produce nothing. You'll have a wet year where you might produce 2 tons. Over 20, 30, 40 years, this is our expected average. So I always like to say that a piece of ground is kind of like a bond in that it can kick out income every year, but it's a bond with a highly variable coupon. And part of the coupon is based on the productivity and weather and climate and that kind of thing. Part of it is based on the vicissitudes of the market for the crop. The value of the crop can go up or down as well. So there's a lot of factors, and therefore a lot of factors of variation, and therefore a lot of variability in the yield in the income stream. But nonetheless, the valuation principle is the same. Present value of cash flows, discounted present value. So that being said, let's take the yield, which is the net income, expected average net income, and divide it by the value, the capital value, and that'll show us a yield as a percent. And then I'm going to calculate that for all of these valuations. Now, what do you notice here? And of course, this converges more and more tightly as we go up in interest rate. The yield is the interest rate. The yield is the interest rate. In fact, the only reason the yield down here is not the interest rate is because there's a little time aspect in the present value calculation. If I made this basically a perpetuity, if I change it in per to 1,000, you'd see that the yield collapses exactly to the interest rate used in the valuation. But close enough, right? Close enough. You can see the yield converges to the valuation, right? And that's the logic, because if the yield were higher, the capital value would go up until the yield equilibrates. If the yield were lower, the capital value would fall until the yield equilibrates. Okay, now that's all well and good, and that's hopefully familiar to us. Now I wanted to show you just one more thing here. Because what happens with especially marginal farmland, actually there's subsidies all over the place, but this is a particularly instructive one because my dad, with a lot of his land, got what's called a conservation reserve program, which is where they pay you money. Ostensibly, you're supposed to take the land out of production, but they've tweaked this program to where you can still get a hay crop. They just want you to keep it in grass. They want to keep something on the soil at all times. So it's not a crop that you plow under. And the rationale for that is that when they plow ground under on the high plains, the wind comes across. There's no trees out there, and it just picks up the dirt and can move it into 3 states over, and it could cause an ecological disaster known as a dust bowl. So there was some rationale there. We're controlling environmental externalities, and you can see the purpose of this. But these government programs sometimes just get out of hand and they become handouts for farmers, which is what we would argue. But all of that notwithstanding, whether you view this as valid and useful or not, nonetheless, the payment to the farmers does increase because it's a payment per acre based on owning certain kinds of property, namely property that you're not going to be plowing. So you can still grow a hay crop on it. You can get the hay income, and you can get the subsidy payment per acre from the USDA for conservation. So notwithstanding how you feel about those subsidies and whether you think they're good or bad or useful or not, I'm pessimistic on all those counts, just for the record. the fact remains that any kind of subsidy, any kind of increase in the cash flow associated with that asset is pretty quickly going to be capitalized in the price of the asset. So let's run the math again. And this time it's the $28 of our expected hay yield plus the $18 of the government subsidy. That's a per acre subsidy. So now this land can earn you an average of 46 an acre. And by the way, the 18 of that will be definitely guaranteed for the length of the conservation um, program contract. The $28, the hay part, that's still variable, but we're treating it as an average again. Okay, and now run the valuation again. I'm just going to copy and paste. And looky here, that land value went up substantially, almost $400, because the income went up substantially. So who captures the benefit from that? The yield is always going to be 5%, right? If another investor comes along and wants to buy this land, he's going to have to pay 913 instead of 555. Is the second investor any better off? No, it's still only going to yield 5%. It has to, because if it yielded more than 4%, another investor would offer a slightly higher price, and on and on and on until the yield equilibrates down to, quote, the rate of interest for this kind of asset, for this kind of risk category. So who gets all of the gain from this? The person who owned and operated the land when the subsidy was enacted. And by the way, that wasn't my dad either, because these subsidies go back generations. So my dad didn't get a superior yield on this land because of the subsidy. Somebody probably 50 or 60, 70 years ago did. Now, let's do the same thing with our yield calculation. I'm going to run the, let's see, let's put those interest rates in here again. So I'm going to run the PV calculation at this rate for 100 years with this, and again, negative payment, lock the reference, 0, 0. Fill it, and let's see, 913 should match here to 5%. Yep, 913. If the interest rate goes down, the capital value goes up and present value goes up. If the interest rate goes up, the present value goes down. All of that still holds, of course. The yield of that cash flow, lock the reference, divided by this valuation is going to equal what? Approximately, or actually pretty exactly here, once we get into the higher interest rates, it's equal to the discount rate at which we valued the asset. So the lesson here, and what I hope that doing this math and walking through this logic illustrates, is that, of course, both the Bocephus principle, that I call it the inverse relationship between interest rates and bond or asset values, and the fact that any enhancement of the income, whether it's through a government subsidy or through increased productivity or something in between, will ultimately, and often pretty quickly, because there's a lot of entrepreneurs out there playing in these markets, and they're looking for arbitrage, and they're looking for superior investment opportunities, and once they find them, they jump on them and they bid up the price of that asset until what? Until the yield is equilibrated with, quote, the rate of interest or the yield on comparable risk assets. So that is a really durable feature. That's a indelible feature of markets and capital markets and valuations. And that's just something I want to kind of implant in your thinking. I'm not saying it's impossible to get a superior rate of return. I'm just saying it's difficult because this process is out there and it's relentless. So you have to be either really good or really smart or really lucky to, and maybe a combination of the three, to have persistent above market rates of return in the long run. Now, if you know the economics here and you still want to try it, I'm all for it. God bless you. Go get them. Go do it. But just know the risk here. Know the caveats. Know the inexorable logic of economics of capital and valuation and present value. So, hope that's useful. Hopefully, this will be a pretty simple exercise. Do exactly what I did in the spreadsheet. Save it. Turn it into Canvas, and a nice score there to round out your homework column. And I'll have a good end of the semester, and I'll see you in the final exam. Ciao.